Hello everyone, welcome to part 4 of our trading masterclass. What I'm going to do today, I'm going to jump on IXIC, which is the NASDAQ. All right, you see I've drawn up a whole bunch of stuff here prior. However, maybe it'd be a good idea to start a fresh chart, okay? So, you know what, I haven't done the Dow, so we can clear this fib off. And let's take a look at the Dow Jones Index today for our lesson, okay? And one reason being is because I'll actually do an analysis as I do this class to kind of give a prediction of what's going to be happening more in the long term, okay? So today's topics are going to be volume analysis, institutional candles, imbalances, and gaps, all right? These are specific to technical analysis because all they pertain to is what we see with the candles. So first thing, what I want to show you are the actual candle patterns. Volume analysis we'll leave till the end, okay? So the first one is institutional candles. What that is specifically is a move. Maybe, you know what, actually, I'm thinking it may not be so good to do it on the Dow because Forex pairs have a much better consistency to all of that. So let's pick, I don't know, USD JPY. Yeah, let's go with that one. These drawings are pointless right now. Remove, good. Okay, so on the 4 hour, we don't need to analyze that deep. Okay, so let's go over, pick a random point in time and stretch it out. Let's go. We need to find what we're looking for first. Let's see. Okay, perfect. So the first one we're going to touch on is institutional candles, okay? What we can see, delete that. What we can see is this particular pattern. So as you notice, whether it's consolidating or trending, it's a very sharp reversal like this, okay? Going down, slowly going down, slowly going down. Giant red candle, almost no wick, and then sharp move upwards, okay? So what this entails is this red candle would be considered the institutional candle. Because as you see, there's no wick there. The next candle opens, slight wick to the bottom, and up it goes. Okay, so what I want to do at this point is analyze a lower time frame to see if we can get a better indication or a better entry. So as you can see, on the 1 hour, not so great. Let's take a look at the 2 hour, right? That would give us better information because on the 4 hour, all it does is include, there was a little candle right there. So 2 hour gives us a better idea that there was one sharp push down and then a quick move upwards. Okay, once that happens, and I'll just close the replay, hopefully we're in the same spot. I'll just draw a box so I don't get lost. Kind of happens when you close replay sometimes, right? Get thrown into a random place and can't remember where I was. Perfect, so here we are. Stretch that out, fantastic. So what does the institutional candle mean? Well, it's quite simple. It's exactly as it sounds. Institutional buys and sells. All right, this is where market makers decide where the next moves are going to be going. And it's really good for traders because this is a good indication of where the market will return to. Almost a high percentage of the time. I wouldn't say 90 or 95% or anything like that, but it is quite high. Almost always when you see this candle pattern, the likelihood of the pair itself coming back to test that area and then reject and go higher is pretty good. So for example, I took a drawing tool called the Gantt box. Okay, so I'll show you what it looks like. Mine just looks like this. Okay, very simple, a 0, a 50%, and a 1. So I right-click that on the settings, and as you see, if I check everything else, it's going to look like a box, right? But that's only the horizontal price level. So if I click on the time levels, right, you get to understand why it's called a Gantt box. Now, I don't care for any of that stuff. I just want the 50%, the 0, and the 1 on the price, and that is it. Not looking for anything else. All right, and I just made it white so it's pretty transparent, translucent, I should say. And what I do with this is I put to the top of the wick, right? So I'll just delete that and we'll grab a new one. I go from top of the wick to bottom of the wick of the previous candle, right? So I'm not going on the green one here, I'm going on the red. So now we've established a 50%. So I'll take a ray and I'll just draw that right in the center. Okay, and we will make that white as well, just so we know exactly what this, what it signifies. So now, what I want to show you is the potential for it to actually come back into this area for a trade. Okay, and now I'm going to draw it on the 0 and the 1 as well, because the likelihood that it comes to the 50% is good, but it will almost always touch that 0. Going to the 1 almost never happens. And that's because this is as low as the market makers want this particular pair to go before rejecting, right? So it's like the last kind of hurrah to get other banking or other institutions in on the trades before taking the price higher, okay? It's what causes volatility. So we scroll to the right and look at that. Right off there, we have 2 rejection levels before it starts climbing. Let's see if it happens anywhere else. Once, twice, so that's 4 times that it came to that area. And now you see, now it's gone. All right, so I'll switch it to the daily to show you exactly what that looks like and where that trade could have taken place. Holy crap. Right, now you see exactly what I'm talking about. Right off of that area, off that institutional candle that we found on the 2-hour, right? Because they can happen on the 1-hour, 2-hour, even as low as a 5 minutes, right? It all depends on where the volatility was. If it's a 5-minute candle, it's fantastic because that almost guarantees a pullback to that area because it was such a sharp move in such a small amount of time, right? But as you can see, 1, 2, and this is on the daily, 1, 2, 3, 4, 5 times it came to that area, right? And the unfortunate thing is it was consolidating for that long, okay? The majority of, like, if you would have entered right here the first time that it dropped, potential 125 pip gain or going down to break even, right? For me, if I'd see that it would hit break even and reject right off it, the likelihood I would enter the trade once more is very high, okay? Because not necessarily meaning that it's going to bounce off one time and then blow up. As you can see, it tests it multiple times before it actually makes a move. The only difference is if I'm in a trade for, let's say, 29 days, a month, and the pair is just going sideways, I'll probably exit and take whatever pips I can see. And then I'll set a possible alert for when it comes back down to that zone for me to be able to take that trade, okay? But I just wanted to showcase what the institutional looks like, how to prepare for it, and how to potentially enter a trade from an institutional candle. Okay, now are there any more that we're going to see? Well, you know what? Let's jump in on a smaller time frame and take a look, right? Because what a trade that would have been. I mean, it was almost a year ago, right? But within the year, it climbed how much? Let's see. We'll just bring it all the way down there. You know, you see how high it went. It's astronomical almost, right? So there we are. I'll just draw from the white line that we see here, right at the top to where we're at now. Almost 3,000 pips, right, within a year. Not the worst thing in the world, but what I'm saying is we ultimately decided where that trajectory was going to happen from that, and I wouldn't recommend staying in a trade for a year. Right? I mean, 3,000 pips is a nice gain, but there's so many other trades that could be taken within that time. Like I proved in one of my chart reviews, I believe it was in May. April of this year was a fantastic month. I believe there was approximately 3,100 pips gained in that 1 month alone. And the risk to reward ratio was incredible. There was one trade I believe I set as of 17 to 1 risk to reward, and it hit. And it hit so hard that it actually dropped further down and turned out to be a 33-to-1 risk to reward trade. That's incredible. That's a multiple of 33 in the investment that you made in that one trade alone that lasted approximately a month or so. All right. So anyway, institutional candles in a nutshell, that's exactly what it was. Let's just zoom in one more time to clarify, right? And as you can see, if we use the 4-hour time frame and draw it up here, right, the center will be around there, right? So I'll stretch the Gann box just to make sure that it is exactly centered, okay? You can see how it actually entered that zone on the 4-hour candle. But you saw the 2-hour was very specific. What we could do is narrow down that trade and have a tighter stop loss, right? So tighter stop losses mean better potential for wins or better potential for gains for risk to reward. So I usually just go a few pips underneath that white line, which would be like 2 or 3. So you see just right here, I risked 41 pips and it barely crossed the top of that line. Okay? And for 3,000 pip gains, I mean, that's insane. That's almost, where was that? 3,000 pips. Let's put it up to 3,000. What it looks like, almost 3,000. There you go, 72-to-1. That's a pretty good trade. That's almost doubling your account, risking like 1 or 2%. That's crazy. Now, 72-to-1. Imagine if you risked 1% of your account, you made 72% profit. Right? If you risked 2% of your account, you just made 144% profit. It's pretty good off of one trade. Right? And if you want to let it ride, you can let it ride. Just be sure to analyze constantly and make sure that there isn't going to be any harsh pullbacks to get you out and make you lose that entire capital that you have already almost gained, right? You didn't secure it, because if you did, it'd be in your account. So anyway, that is institutional candles. Next, what I want to cover is imbalances. So another fun word, and what imbalances are very sharp moves in one particular direction that almost always have a retracement. Okay, so as you can see, on a 4-hour, right, just a long red candle and almost nothing happening to that afterwards. So let's grab a replay and let's see what happens within that candle. Okay. And the same principle applies as doing the institutional. I'll take the Gann box from wick to wick, find the middle of it, and that'll be a rejection zone, because it'll typically pull up to that 50%, right? Or if you even want to do a fib off that candle, right? You can see that it just touches the 618, right? So I'll show you what that looks like. Let's drop it down to the 2-hour, right? So that's what we can see in the 2. Let's drop it down on the 1. Okay, so the 4-hour is where we have that nice big candle that needs a pullback to happen. Okay, and look exactly what it was, right? If I put the replay here, right, we saw that it dropped and started going sideways. Okay, so it kind of hit a supply and demand zone, as we covered in the previous video. So after a giant candle like this, this is what I do. I take a Gann box from wick to wick. Okay, what that tells me is there's a very good chance that this is going to continue down. Okay, so I take a short position right here, stop loss slightly above that giant candle, right? So 42 pips in this case. And, you know, target as what's the lowest possible target we can hit. What I would say is that this is probably just a retracement for the long term. So I would say the best chance would probably be down to here. So, I mean, that's not even a 2-to-1, maybe not even worth taking a trade, right? But let's see how it plays out. Okay, so I'll just slide it over right there to the 50%, right? I mean, we kind of saw what the chart is like, but just a good example. All right, there we go. TP hit, almost. Almost, I mean, this is what I'm talking about, right? Like, when you have the target zone and it's like a pip off, I mean, I would still consider that TP hit, right? Look at this. Not even a pip. 0.6 of a pip off. Not too shabby, right? But now you see exactly what I'm saying. Gann box entry, Fibonacci just on this large candle. You know, the 618 was perfect right here. So if we draw it up, watch this, right? Fib just on the candle, not on the entire drop, right? Because it'll be a little bit more exact right there. So now you see 618, just a little wick above. So imagine taking an entry like this, and make it much tighter down to there. So now 20 stop loss becomes much more profitable, doesn't it? And this move kind of concludes within a day. Okay? And it all depends on your analysis. If you're willing to risk the same amount for a 20 pip stop loss instead of a 30 or a 40, that's completely up to you, right? What I'm saying is it's safer and more profitable in the long term because you'll win consistently if your stop loss is reasonable. If it's tight all the time, the likelihood that it just wicks off the stop loss and continues on its trend is pretty good, right? So I've learned that when I'm taking market structure trades, 60 pips is my threshold. That's as big of a stop loss that I want to have. And the smallest is between 30 and 35. If I go smaller than that, I mean the potential to have a very nice win, like look at this. If we knew this was going to happen, it could have even done a 12 pip stop loss. But we don't know what's going to happen, right? What I'm saying is there's a good probability that it will happen, right? So if you do it every single time you see one of these, chances are you might actually win through them. Like look at this guy on the 4 hour. Similar idea, right? We take the GAN box from wick to wick, draw it across, right? But it doesn't hit the 50%, so that would be a loss. That wouldn't have even been an entry, I mean. Okay, so irrelevant. But look at this one. Big red candle, draw a GAN box from wick to wick. Look at that, right off the 50% and down it goes. Right? So the chances that this actually happens off big imbalances is pretty good. And look, what would the stop loss be here? 29 pips right off the top of the candle. You know, who knows how deep this would have went. But at the same time, when you see consolidation for several days, right, because we're on the 4 hour chart, pretty good idea that you might want to exit, right? And a 3-to-1 on a quick trade like that is always good. Okay, so let me dump all these drawings. And we'll remove the replay. So again, in a nutshell, it's very large candles that don't have any play in behind them. That's what you would consider an imbalance, right? So for example, this one, not so much an imbalance because we have a candle and a wick previous that kind of go up just close to the halfway point. So the way to be able to find an imbalance, it's not just looking for giant candles in one direction, it's looking what's before and after them. Okay, so take a look, for example. In this candle, that is a gap of just pure green going up, right? So what would it look like on a smaller time frame? What's within that? Still the same thing. This is on the 2 hour. That means that's a very good chance this is going to be in play. Is it going to be in play right now? It's hard to say. But now watch what happens, right? We saw, if we scroll down here, look how deep it went, okay? So how interesting is that going to be? Watch this. Okay, we'll draw a fib from this low to this high. Look, we just touched that 618. Okay. Interesting how that is slightly below this candle, right? If we take our GAN box right here, and like I said, draw it from wick to wick. If you're risky, I mean, you could draw it right where the gap actually is. Right, for a very tight entry. I mean, I personally don't like taking these kinds of positions. They are a little more riskier than the others, but the reward is definitely worth it. So let's go to there. Watch this, right to the bottom of that box. 15 pip stop loss. Look at this, right? 618 retracement. It did a retracement, started pulling up, right? Because we don't know if it was going to actually pull up, but target would be the previous high. So look at that, almost a 9-to-1 ratio on this trade. Let's see what happens. I'll just hit play, let's see. Done. See that? Beautiful. It hit. And as soon as it touches that, that's when the exit is, right? I mean, we know, judging by how this is looking, there's a potential for it to go higher. But that requires this tool right here, trend-based fib extension, to predict how high it could possibly go before a reversal, right? I would say with that kind of entry, we're looking pretty good, right? Bring up your stop loss, but you see, be careful because these kinds of moves happen, right? So if you brought up your stop loss, look what formed, an institutional candle, or not institutional, sorry, an imbalance, right? Big imbalance formed here. What are the chances that within the imbalance, there's going to be a potential trade entry, right? Let's take a look. what's in the entirety of the candle, in this whole imbalance, right? Here we go. Almost at that 50%. But you see, it doesn't pull down there every time, but it comes pretty close, right? So imagine if you want to take an entry. I mean, it wouldn't have entered anyway, but, 34 pip stop loss. Not too bad, right? Let's keep playing it, see where it goes. And now it drops. So that move right there fills the imbalance. You see it dropped all the way through that, filled this imbalance. Now, what I want you to pay attention to is the wicks, right? So are we going to consider these institutional candles, or sorry, imbalance candles? Keep getting those two words mixed up. Pardon me for that. But now look, okay? Look at this candle. It has a big wick, that's fine, but you see this previous wick and this one right here, it just leaves a tiny gap right there. That's not going to be in play, okay? That's too small. That one, both wick before and after cover the entirety of the body, definitely not in play. This has a potential, but it covers over 50% of it, not in play. This one, you see the wick covers more than 50% of it, not in play. Okay? Let's keep going, see what we can find. You see what I'm saying? Not in play? It's exactly what I'm talking about. Okay? See, big green candle, but it's not in play because this one came down to at least 50%. Right? So now it looks like it's consolidating for a little bit. Let's take a look. Let's see if we can find any other spikes. And this is what happens after a nice sharp trend move, consolidates for quite a while, gives us traders a good opportunity to analyze. What do we have here? Would we consider this an imbalance? It's a little small, but you could, right? I mean, it's within consolidation. It's not huge. It does not come up to a 50%, but it's also a very small candle, right? So overall, I would say this sort of thing is not worth it. We're looking for candles that are maybe 60 pips at least, right? You see that big thing? That's what we want, right? Even this guy right here, right? So you can see it's about 57 pips. It's a pretty significant move in a 2-hour time frame. All right, so let's continue watching. What can we find? Right, so another example. This one is small, right? So, I mean, at your own risk, but at the same time, it does not come to the 50%. So it's not really that worthwhile. All you see with this big move, it fills this imbalance, right? So look, big move down, sideways movement, big move up. And it just pretty much covered the entirety of that candle, okay? Let's continue. Maybe I should have some background music playing with this. When I edit, we'll see what I come up with. But just watching candles move, it's not as exciting as everybody would say. Okay, now here we go. Here's an interesting little move. This does not come up to the 50%. But as you see, if I switch it to the 4-hour time frame, this becomes much more valid, doesn't it? You see how this candle is much stronger than it is on the 2-hour? This is why it's important. If you see patterns emerge and they don't look quite right on a certain time frame, shift it around a little bit, because you might be able to find something on a smaller or a higher time frame that is totally valid to take a trade, right? So look at this, right? So there is no wick here. So the bottom of the candle, top of the wick, look at this. Not too shabby. Right, what's the size of this actual candle? Over 60 pips, right? Including the wick, it's 77. So what would we do? I would take a sell right here, stop loss just above, so 43 pips, and the potential it can drop lower, right? This is what we want to find out. Is this an actual retracement? Let's check from the high, right here with the fib going down to, geez, click fib, thank you. From the high right here going to the low. Hits that 50%. The possibility can go up to the 618. It's pretty good, right? But this is our short-term trade idea. So let's press play and see what happens. Not too bad, right? So as you saw, within this candle itself, right on the 4-hour, it was very valid. A miniature little snag, right? What happened is January 12th that happened, and it pulled back up January 17th. So you had 5 days to be able to find this if you're combing through your charts, right? And now look, did we snag TP exactly? Not really. How close did we come? Exactly a 3-to-1 ratio. It's crazy, right? But anyway, let's see if we can actually hit TP here or if it pulls back up. Oh, there you go. Snag TP right there. Double tap, right? Good sign that, hey, it tapped the exact same spot, but it didn't go lower. Now you understand why I pick it right where that bottom is in the retracement to be able to snag from there to there, right? I don't go lower because now I could potentially be breaking even when I could have been at a 3-to-1 profit. Okay, let's keep going. Interesting how that worked out, right, guys? So now you understand the incredible validity of doing your fibs, doing a Gann box, finding your imbalance. Now you see I'm compounding the amount of indicators and tools that I'm using to do my analysis. Okay, and I'm playing the replay. Like, I know overall this is going up, but I'm taking trades on a sell, right? I don't know where they were. Like, I didn't scan this back in January and examine this right before the video to make sure I got every single one. We were doing it live, right? So I picked this out on the 2-hour. I switched it to the 4-hour. I see a nice imbalance candle. I drew the Gann box, right, before it dropped lower to show you where it wicked off. Then I did the Fibonacci to make sure it correlates in that area. And then I didn't take TP past this line. All the rules that I just said to do before I mapped this out prove to you that it works. Okay, let's continue. Let's see what we see coming up, if there's going to be any other candles. So far, nothing, right? I mean, if you have a nice move like that, it tends to consolidate for a little bit. Okay, so this is very unique because there was no inclination that this is going to go up, right? You see this move on the 4-hour. Typically, when I have no large candles coming up, and there's a big one dropping down, maybe I'll just change my time frame because look at on the daily. This is what it looked like on the daily. Okay? So on a daily, that definitely makes an institutional candle pattern. Okay? The trouble is when we're looking at a 4-hour, that just looks like any old random drop, right? It's very, very deceiving. So at that point in time, what I would do to be able to see if it's a decent entry, right, if it broke a previous low. Now, my only concern is because I don't see any candle patterns of interest. This is not telling me that it's breaking out or it's going to be a sharp move. This is a very stable trend upwards, right? So as far as analyzing any imbalances or institutionals, that is not really going to help you here. Okay. Now, what I want to explain also, you're going to hear the term gaps, and gaps are what form within imbalances, right? So it's going to be good now to show you the volume, fixed range volume profile tool because it explains perfectly, right? There's what's called a point of control. So let's just draw it up from consolidated areas, right? So from here all the way to here, right? So what you're going to get is this large red line, and I'll just right click on it and show you the settings. All right, there is a tutorial that I have on the how-to trading view as to how to set this up, and these are my preferred values, right? So placement left, I like going on the left side because the right is where the charts are actually moving, right? I don't care about the highs, the lows, the developing, I don't care. I just want the point of control. Okay, I don't want a whole bunch of color. I just want everything gray, right? These are my inputs, and this is the visibility. I mean, this doesn't really mean much, okay? But the style is important because I don't really care about up volume, down volume. I just want the major volume, okay? So now look what happens. We draw up a volume profile in the entire area that it's been consolidating, okay? So even before this red candle, right, let's just draw it to here and let's see where the point of control is. Okay, here we go. So big point of control, I'll just draw it right here, line it up, and we'll make it red just like that one. Okay, and then what you see are these little spikes. You see the tiny little spikes that come very high but don't come as high as that point of control. So I'll draw a few more rays, right? But I'm going to change their color shortly. So these are what you call extreme zones, and that means that it's not quite the point of control, but they are sharp enough that it does signify that there will be some sharp movements within that area. Okay. So there's no gaps in here. This is all filled and this is all high volume. Okay, where's the point of control? Look where that red line is. Look where that aqua line is, right? They're all being tested and it looks like this is just moving within them, right? So this is what I see. It moves up, doesn't really want to go that high, retests, goes down, doesn't want to go that low, retests, goes up, doesn't really want to go that high, drops, doesn't want to go much lower, right? And then starts suddenly going up. Retests a little bit with that wick, but closes higher. Keeps going, kind of drops a little bit more with that wick, keeps going higher, right? So right now what I see is these EMA lines expanding. I see this trend starting, right? Would I have been able to catch it? I mean, thing is, while it's live, this is what I'd see, right? Who's to say that this isn't going to continue? You see? What's the chances that this is going to spike up when it's already done this 1, 2, 3 times, right? I'd be thinking, hey, you know what? It's just going to keep consolidating, but let's see where it goes, right? Oh, now it formed a newer high. You see, it broke through that previous area where we were consolidating, okay, right here, right? You see, this wick was the highest point, and then it didn't really break it until it started consolidating on that area. And then it used it as a support, right? Hence the previous video, support and resistance. You see how we did that live. We drew up a line as we're seeing the chart go, okay? So now, what I'm seeing is, hey, this is the next peak. Once it breaks through that, that means it's going to be very likely a new trend starting, right? Because it broke through another area of resistance while it was consolidating. So let's see what happens in the next candles. See how it tests, wicked just above it and closed below it. But because of that wick, right, we're on a 4-hour time frame. Look at the 2. Okay, now look at the 1. Now the 30. Now the 15. Right? So you can see it's just a wick that went above there. So it was very brief. Even the 5-minute barely got it across. 3-minute, we're not going to get that low, unfortunately, right? So now I got to find my position once again because it zooms me out all the way to August. But yeah, we're right here. That's fine. So replay here. Okay, and then I'll zoom it back out. You know, we'll play it because, I mean, it's further gone than this, just to make us go back to the same spot. But as you saw, like, we tested that 5-minute, didn't we? Okay? And within that 5-minute, you even saw that it just wicked off. So, you know, we're back to the 1 hour. So now let's just go forward slowly. See, it's resisting. So right now, I'd be like, oh, maybe it's hesitating. I don't know if I'd want to take the trade. Now look at, now this means that, hey, it's broken through. This is going to be a good sign for a strong trend upwards. Okay? Now again, you could have risked it way down here, but there was nothing showing me that it's a potential for it to go higher. Right? No institutionals, no imbalances, no gaps to fill, just the points of control in extreme zones. Okay? So taking an entry early is risky. I mean, profitable in this situation, but it is risky. Okay? And now look what we got. Now we're climbing. Right? But after that candle closes, that's what would signify that move. And a good way to tell where momentum is heading is one of my favorite indicators, the MACD. Now I just changed some settings so these area, the histogram would just look like little mountains and valleys rather than bars. And the signal line is edited so when it's going up it's green, when it's down it's red. And the white line is kind of like the higher EMA medium for the signal line. Right? So now look what happens. We were just going, the MACD and the histogram is just kind of going sideways even though that this is climbing. That doesn't really tell me that this is a strong trade. But look, once we broke through that area, look at the MACD and the histogram here. You see how it's starting to spike up higher than what we've had before. Right? Because here, we've spiked up, but it didn't really make much more significance than way back here. That's called divergence. Okay, we'll teach divergence later on, but for now, this is what I wanted to show you. Okay, how valid volume becomes, support and resistance, and everything else that kind of get added together. All right, so that is, I'm going to try to do volume profile once more. I'll just get rid of this replay to kind of show you an idea, and I'll do this one live. So we'll go with where USD JPY is now. I believe it's way up here, yeah. Okay, so let's do this on the daily, okay? We don't really need all that data, but now check this out, okay? What I'm going to do is analyze from this bottom right here to the top. So let's take volume and right when it hit the peak. So volume where it started to where it finished, right here. And again, it's just a side-to-side thing. It doesn't matter if you actually go from top to bottom like fixed range volume profile. Or, sorry, as a Fibonacci. We're using the fixed range volume profile, my bad. Okay, so one thing I want to show you. Look at this, okay? On the trend, that's a very close retracement on that trend, okay? Let's just change that to red because that is the point of control, right? So now I want to show you one more thing. We did the fixed range volume profile. We've assessed at this peak, and it started to drop, right, because these are daily candles, that the potential for it to return here is very good. Does that mean that it's going to break through it and do some zigzags in it? No. That just means that it's like a magnet. It has very strong pull to come back to that area, but that doesn't mean that it's going to cross it and start going down all of a sudden, okay? So this is where we're currently at. And we've rejected off that area. But look, it's having a hard time breaking that previous high, okay? So within this, let's draw a Fibonacci. Right here, this was the lowest part to the highest part. How does that correlate with our fixed range volume profile? Pretty good. Look at this. Between the 618 and the volume profile, that's the gap. Okay? So if you want to be taking a buy, a good probability for that to happen would be taking it right at the 618, setting a stop loss underneath the volume profile, and taking TP at that previous high. Right? It could take a while because as you see, it's 142 pips. So maybe not a trade that you'd want to be jumping into because it's super big, right? It's a huge stop loss to have, right? I mean, unless you have a large account to be able to take a stop loss like that and actually be profitable, you know, you're going to be in a trade for a long time. And this is upwards of a month that this is occurring, right? And it's still not TP. Like 5.6, we could probably get that in a few days when we find tighter entries. But just as an example, this is the preferred method for trading 3 other things than Forex, okay? And the 3 things, well, I mean, I guess technically 2 because metals is really just one thing, but silver and gold and oil, those 3 things, these tools are phenomenal for, okay? It's so predictable once you start getting used to doing this type of analysis that it's going to be shocking you didn't know about it before. Okay, let's, as an example, UK oil. I never really drew up on this chart, okay? So watch this. Let's see, volume profile. This was the bottom of the trend. Here was the peak. That's where the volume profile is. Personally, I don't think we're going to be coming back down there. But we'll draw it anyway, okay? Where are the extreme zones now? We have one here, and we have another one here, and we have another one here. Those are pretty much the big ones. Like there's, this peak is a little less than that one, so those are the 4, right? So here we go. Let's turn this one aqua. Where was the peak? There, aqua, and this is aqua, right? Yes. Okay. So here's our fixed range volume profile on the trend upwards, okay? Here's a fixed range volume profile from the drop into a bit of a consolidation. So we're going to do it right here to the final peak before it started dropping, okay? There's that. So here we are. That's another area, right? How significant is this? Look at how that's peaked up. So we'll draw another volume profile right there. Make that red. Okay, and I won't do extreme zones just to kind of, well, I mean, I could just to showcase how everything is, but we'll leave this alone for now. Okay? Fib from bottom to top, right here, and I'll stretch it across. What more do you need? Do you see how obvious this is now? When you have multiple indicators showing you the exact same potential spot for a reversal or a continuation or anything like that, that really boosts my confidence to be to know that this trade is going to be very valid, right? The trouble is, how many times is it going to pull back to that area, right? So how deep would you want to be taking this trade? Because 463 pips on this is a $4 move on oil. Okay, so personally, $3 on oil is kind of the most I'm willing to risk, right, for a stop loss. And as you see, sometimes in the day it goes much further than that. But as long as your analysis is on point, 3 should be plenty. And oil, more long term, I would take it up to there. Look at your risk to reward, 15 to 1 on this trade. And so far, it's looking pretty good, right? So if you actually entered way over here and kept your stop loss and didn't, or just set it to break even when it spiked up and then dropped one more time, but then you saw a rejection right back at that zone, might re-enter, right? When you did your long-term analysis, this is from December to now, right, to August, beginning of August. When you saw that this is happening, you would be waiting for it to get to this area. You would already see this coming. Okay? Now watch another thing that I'm going to show you, where within the trend, there's also another trend, right? You can see that I drew up a volume profile here, and we have another point of control. So if we take the Fibonacci from that new high that it finished off on, right? When we drew all this area, this is included. So we're talking this point right here because it kind of dropped and hit a point, right? And the kind of point that it hit, you can see 618, boom, reversal, crazy. Like I was saying, it's predictable. Okay, so look, from point to point and draw it across, right? Look at that, point of control and the 50% align in the same spot, right? The chances of it actually hitting off there are very good. And sure enough, what happens, right? You could have taken a sell off that area. What'd I say, $3, right, for a stop loss? That'd be 300 pips on oil, approximately there. You know, good buffer zone. And then target right here, right where we're expecting it to go. Look, you made a 4.7 to 1 risk to reward in how many days? Took an entry 1, 2, 3, 4, 6 days, 7 days. Not bad. That's a pretty good swing trade, right? Within looking for that next trade, you were still able to capitalize on the way down, right? Because you would be able to figure out with all of these tools where it's going. And as you see, as I'm doing oil live right now, that doesn't necessarily mean that, you know, you see all the effort that I put in and I talk out loud and I make sure that, you know, I want to convey everything I know to help you understand what you're seeing. This analysis, if we're going on every pair, it's going to take some time. Because right now, I've been doing oil for maybe 10 minutes, right? When you're new at this, it's going to take some time. You're going to need to find out where to draw the fibs, where the volume profiles go, how to align them so they look like this, right? So if I click on my settings, you see exactly what I've highlighted. I put things at the same color for, you know, for my own personal benefit, so I know what they mean, right? You're going to have your own trading style. I just want to help bring that out in you. So to give you all the tools that are in my head on this program so that you can use them and assess your own stocks. Because even if you follow someone else to make trading calls for you, the best thing you can do is analyze it yourself and then know for sure if it's a good idea or if you disagree with it. And that will help boost your confidence. Because imagine disagreeing with it and being right. And you see the pros that have been doing it for years, you know, bunny quotes, years, and they get it wrong and you get it right more often than them. It's awesome. And I gotta tell you, it'll happen more often when you learn all of these things. So stick with the boot camp. I promise you it'll be worthwhile. So end of my rant. I'm gonna keep these drawings up just to showcase that wonderful entry. Okay, and again, UK oil. US oil, crazy, I already drew that up. Look what happened. The exact same move, right? US oil and UK oil are almost identical. They move very similarly. UK oil is sometimes a little bit more exaggerated, as you've seen. So maybe UK oil would be the better one to take trades on compared to US, but I mean, that's a personal preference thing. Do whatever you like. They both have very similar moves, right? So as you see, I have the reds, the greens. When I showed you the Fibonacci channel the other day, you know, that's what I use alongside everything else. So I have 3 indicators that would show me the same thing, right? What do we say? The trend up, right, from here to the peak. Where's the volume? Way down here at the bottom, but a big spike is right here on that green line, right? So green line would have been valid on the US oil, right? But UK oil shows a different analysis, right? We had a spike right here, right on the fib. So maybe if US oil doesn't work out, UK oil is the way to trade. Personal preference anyway. So just to reiterate, we've covered the volume analysis, which is in front of you, using fib tools kind of within that volume analysis. But again, there's a how-to video on everything Fibonacci, so I recommend you jump on that one and replay it a few times to understand what to do with it. Institutional candles, imbalances, and gaps within the imbalances. Okay. The only other thing that I forgot to mention is gaps within the volume profile. So in this instance, this tiny little move right here would be considered a gap, right? So this eventually needs to be filled. And judging by where it is right now, so let's, you know what, I don't want to delete it. Let's hide for now. Can we hide it? No, it doesn't matter. This is easy to draw back up anyway, so forget it. We'll just get rid of all that. I'll leave the points of control up. But let's switch it to the 4 hour, okay? And what you're going to see if we draw up a volume profile over the last few days, okay, so let's say from the bottom here to the peak, right, this is a gap. Look at how it filled that gap twice, okay? Within this tiny little area, that means that oil got taken up very quickly and no one had really any time to react. So when that sort of thing happens, like look, right here, it's so tiny, right? It's within that move, but you can see that below that gap was a little resistance, and right above it, that's when everybody started kind of jumping in. It tested it, it closed it, and now it's climbing again. Pretty interesting to see, okay? On the way down, watch this. We draw another volume analysis from peak to bottom right here. What do we see as far as the analysis goes? Where are our gaps? You see tiny little spikes within this 1 hour, so not so much. Here is the gap, right? Right there on this big candle. And look, it's being filled right now. It consolidated for a few hours in that area actually, and now it's going up. Okay, so all of those tools, all of those indicators, practice them, guys. I would recommend doing a ton of back testing. You're not going to get good at anything unless you practice. Okay, so pick 1 or 2 pairs and go back, you know, do a replay, go on the daily, do something like this, okay? And I'll just delete these ones. The lines are all I really need. So go all the way back and, you know, even right here, right? Hit your replay, go right there, start analyzing, right? I mean, you kind of saw what was happening, but now what you can do is, hey, I'm going to take my volume profile from the peak to the bottom right here. Let's see, POC is right there. 123, you know, it's pretty high. We'll get back to that. Right? Okay, so there's a gap right there where it was dropping. Crazy how it consolidates within that area. But you don't really get a whole lot of information, just a few spikes and whatnot, right? So maybe we went too far back with that one. Let's switch it over to the 4-hour. I'll leave that red line. I'll show you what happened with that in a second. Okay, so you know what? Let's analyze right here. There's the peak. There's the bottom. Okay, there's the volume. Red line, boom. Okay, point of control, are there any gaps? Not quite, we're not going to count right at the bottom. However, what do we see? Oh, that's not an institutional, it's too small. Okay, the biggest gap that we have is just right here, a smaller one right there, so I would say point of control is more valid to play off of this. Let's take a Fibonacci, draw it from top to bottom. What do we see? Holy crap, a 618 right at that red line. What are the chances that this is going to be a valid trade going down? Let's take a look. 300 pips. Okay. And potential TP back to the bottom where it's at. Let's press play. Might be a little slow, but that's okay. Well, to be fair, I just realized it's not going to pull back there because this was the pullback. So, my bad, but that would be a little bit better, right? I mean, you saw, this was the complete drop. So, to be fair, I mean, no, you know what? I'm right. I'm right in this one. This is where I would set it. So, I'm going to leave it alone. It just might take a while to get back there because we're on the 4-hour time frame. Okay, so no, this analysis is correct, right? Because this was part of the initial drop. So it hasn't retraced yet. It did mini retracements on the way down, right? So for example, this peak right here, like you see this click, damn you, holy cow. This peak right here to the bottom, move it to the side, 618. Okay, but volume didn't really align with anything there, so that's why I wouldn't be looking to take that trade. Okay, but again, if you see these little spike ups and it continues down, you finally make your low and it starts pulling up, right? You're gonna be able to analyze, hey, maybe there's gonna be a potential for another entry. But anyway, let's see how this goes. I'm kind of intrigued in my own analysis right now. Okay, we'll just stretch this out. Might take a while to get there, right? Holy. Are we going to get there? It's rejecting off those EMAs. Come on. Don't make me look foolish. Let's go. Come on, you're almost there. Oh, it's being stubborn. What a butthole. Oh, what? Come on. Hit the entry. Hit the entry. There we go. There's the entry. Oh shit. Well, there you go. Didn't work out that time. But within that analysis, what happened? Right? As it was pulling up, it looked like this is either going to reverse at a higher point, right? Maybe it's going to this extreme zone. So let's take a look right now because we just broke structure, right? And we lost that trade. It is what it is. Sometimes it happens. Okay, but you see it pulled up to that area. It played around the volume a little bit, broke through, and then crushed it. Okay, it's unfortunate, but it's going to happen sometimes. All right, now let's see how it plays off that top area. Okay, so as you saw, it broke through once, came back down to that zone. Personally, I'd probably be looking for another sell entry here, right? Because now you have the EMA shift. This is a very good chance that it could potentially drop lower. So let's stretch it out one more time, and let's see where it goes. Okay, so broke even. Would you enter again? I mean, it kind of dropped in, it's testing it several times, right? I may have entered right there once again. So right here would have been another potential entry, right? So it doesn't really look like it wants to go very low because another break even happens. So, but you see right now the point of control, how valid it is. Everything keeps coming back to it. Like it doesn't look stop loss, but it didn't hit the stop loss, just kind of bouncing around this zone. I would be way out of this trade at this point. Like this is just too long. All right, stretch it out even further. Let's see how this actually moves. Okay, I'll switch to the daily. It's taking too long. Sorry. Oh, jeez. Okay, let's keep going. Right? Look how valid this area becomes. Point of control 618. Everything's hovering around there. Right? And it just okay. So there we go. Broke that area once again. Okay. So now it's finally dropping. You see? But now what intrigues me is that these peaks happened here. Okay. So that means there's something going on in this area. Oh, I'll cancel out for a second. Something going on here. Okay. Switches to the 4 hour. What do we see? Some consolidation. Okay. Volume profile in that consolidation. What do we have? Another point of control right there. Okay, so I'll draw that one red. This point of control is invalid. This trade sucks. Right? It peaked up higher, but it didn't want to break through that extreme zone. So what I would do at this point, take a look right here on oil. It rejected. It didn't want to go higher. 300, right? 300 is what I said. But now look, I'm going above that line. I might want to make it a little tighter, maybe 250. And wherever the fib bottom was right there, let's go nuts and go all the way down. Because as you see, it didn't actually form a new high even though it's there. That means that it's just a very deep retracement at this point. Okay? So let's see how it actually works out from that. Or no, not that area. We'll draw it up because that's where the volume is. Okay, so press play. I should probably move it a little closer. Okay, and as you saw, it's the peak that hit. It consolidated in that area a little bit, but it didn't form new highs. So it's possible it wants to pull back there, but we'll see again how that works out on the 4 hour. We'll switch it back to the daily. Geez, I don't want to sit here and waste your guys' time, right? Just watching a replay. But here we go. Let's see what happens overall. There's a lot of oh, there's entry. Oh, how good is that? TP hit. Bingo. Look at this monster. Holy right? So now you see exactly what I'm talking about. It was the peak there, right, that interested me because I'm like, what caused that move? And if I would have been able to catch it sooner, that there was a little bit of volume right there, look how valid that entry would have been. Look at this. Do I need 250 pips stop? No. I could have done 100 even. And this would have been an amazing trade. 18 to 1. Right? The trade itself lasted about 2 months. I mean, the thing is, though, it went way lower than I expected. 31. Does it go lower? Yes, it does. So here, let me give you one point of advice, folks. If you're in this trade for a month already, look at the EMAs. If the yellow does not cross the red, you are not dead. Stay in the trade. Look at this. Doesn't cross, it comes close. Look at it, keep going. They're still separated. Still separated. Let's see how far it actually goes until they cross. Now I'm out. Yeah. Exit is there. 62 to 1. I mean, it took 6 months. That, with a trade like this, you need 1 a year. It's pretty good. So yeah, just wanted to show you that one perfect trade a year like this, what a fantastic way to be. All right, guys, I'm going to end it there. Please do some research, do your homework, and if you want to look, just take a screenshot of this time. It was October 13th, August 2013 to about January 2015, right? So even look at that. Look how crazy that entry becomes, right? How valid. August and September. And look, the entry was in June, a year later. Don't discount on the daily time frame, guys. This is crucial. A lot of people just overlook the big ones because they don't want to wait that long. But imagine if you waited for this. Do you see that? Like I said, 62-to-1 ratio on this. Okay? Moves like that don't happen often, but when they do and you catch them, damn. All right? Hope you guys enjoyed this, and I'll see you for part 5.